Welcome everybody. This is lecture 5 in a series of lectures which would be given to undergraduates who would be doing a degree in banking and finance and thinking of careers in financial markets. The first lecture started by explaining the roots of money, banking and finance, and the subsequent lectures started to deal with some of the terminology so that people were quite clear what words mean, and they do vary sometimes from the layman's understanding of words, and it is important to get these organised and clear in your mind. There is a postscript to lecture 4 because I'm an economist as well as someone who teaches in banking and finance, and some of my economist colleagues said the explanation of capital wasn't quite right, was it? Because we don't understand capital in exactly that way, and there is a difference in the way the word capital is used in finance and in economics. In economics, capital is just a produced means of production. So in economics, a factory, machines, computers used in business are all produced means of production, and capital is one of 4 productive factors in economics, where you consider natural resources as land, you consider people as labour, you consider produced means of production as capital, and you assume sometimes, not always, a 4th productive factor, which is the entrepreneurial skill. So that's in economics what capital means. Now in finance, capital means, and when we were talking about capital adequacy in the last lecture, capital means own funds. It means funds that you own. And there's an obvious similarity when you think about it between capital used in economics and capital used in finance. But there is a slight difference. And there is certainly a difference on capital in business when you look at the effect of debt and equity on capital. Now, I thought this was going to be easy. I thought I'd put a couple of numbers down and just explain this to you quickly before we get on to lecture number 5. I'm not quite sure whether it will look as easy as I had hoped, but here we go, just so you can get the difference here between debt and equity and its effect on capital. You remember in the last lecture that I explained how capital would develop quite simply in a firm over a period of time, and I just set up a situation where one person was setting up their business, and in setting up their business they had put £100,000 of their own money into that business to run it for 1 year, and fortunately for them they made a nice profit at the end of first year, which was £100,000, having received revenue of £200,000 and costs of £100,000. They made a profit of £100,000, and I then said if they decided that they were going to have a slap-up party and spend it, buy themselves a yacht, then at the beginning of year 2 they wouldn't have any capital at all in their business, own funds. But if they put it into a reserve account in their business, then they would now have £100,000 of capital in their business. Just suppose year 2 was a break-even year, cost 100,000, revenue 100,000, no profit, no loss. The equity that you have in your firm is the capital. It is £100,000, so things have not changed in year 2. But then suppose in year 3, and this is one of the reasons why it's good to have capital, in year 3 you made a loss. You only got revenue of £50,000 and you made a loss of £50,000. You use up your capital to survive that little bit longer, and your equity in the business has now gone down from 100,000 to 50,000. Your capital is now 50,000 in the business, your own funds left in the business that you could use if times continue to be difficult, is now £50,000. Now let us suppose that I decided it would be a good idea to get my sister involved in this business. So rather than being a one-person business, I persuade my sister to come in and become an equity holder in this business and give me her contribution to owning the business of £50,000. Also, in year 4, it is a good year once again, and costs are at 100,000, but revenue is 150,000. So we make £50,000 profit. Now the equity in the company and the capital in the company has gone up from 50,000 to 150,000, which is the profits that we've put into the reserve and my sister's £50,000 that she's put into the business. So capital is now up at 150,000. Now, year 5, I decide that I've got a great idea to expand this business, but it's going to be a fairly quick fix. So I don't want to issue any more equity into this company, take on any more owners. It's me and my sister against the world here. And I borrow £50,000 from the bank. I don't make any profit this year, so that wasn't such good news. But we've now got debt in this business of £50,000, and the equity has fallen by the value of that debt that we've borrowed from 150,000 to 100,000, and so the capital in the business is now down to £100,000. So I'm not sure whether that makes any things clearer, but I thought it was going to be clearer until I started to think about exactly how to illustrate it. But the important point is that you understand that capital in finance, capital in business, is the funds that you own, the funds that you can use to guard yourself during more difficult times in the business. That was where we finished the last lecture for, and my apologies for taking up the time of those people who really were interested in getting into lecture 5 as quickly as possible, because lecture 5 is entitled Are Financial Markets Efficient? And there's a lot of terminology here that you need to get used to, or you'll hear and people speaking about. So I will go through here a number of points. Now we said financial market, so let me just explain clearly what a market is and what market pricing is. If you go to my series of lectures on economics 101, then lecture 2 will explain this in much more detail for those of you who become very interested in this. But those of you who are not particularly interested but need to understand this, let me just go through a simple example of a market and market pricing. Now, lots of people would disagree with me here because they don't like starting with fairly simple models of how things work. They like to go straight into the complexity and often poo-poo the simple models. But I do like simple models because they start to create some clarity in a mind which can then build complexity and difficulty into the model. So let's just assume one little market that we're going to look at in finance, which is the loanable funds market, which is people who want to borrow money and people who wish to save money. On the vertical axis, we're measuring the price of money, which is the rate of interest. And on the horizontal axis, we're just measuring the quantity of savings on the quantity of loans. Now, demand function is downward sloping from left to right, suggesting that as the rate of interest goes down, people will see more opportunities and demand more loans. As the rate of interest goes up, they will see less opportunities and demand less loans. Straightforward downward sloping demand function. However, the savings function is upward sloping from left to right, because the higher the rate of interest, the more people are attracted to put their money into savings, and the lower the rate of interest, the less attractive they find savings accounts. And the nice thing in economics is you then get a market price. You get a point where these cross, and that's PQ, where P is the market equilibrium rate of interest. It's the rate of interest where the quantity of loans demanded is equal to the quantity of savings supplied. And we have here the further illustration of what happens when the market is in disequilibrium, what happens when prices are too high or prices are too low, and we get all those arrows at work, and those arrows are just market forces. If the price is rate of interest is P1, then the quantity demanded at that high rate of interest falls to Q1, but the quantity of savings supplied increases to Q3. So you have a surplus of funds available and not enough people borrowing them. So what happens is market forces get at work, pushing the price down back towards the equilibrium. If the price, the rate of interest is too low at P2, then you will get the quantity of savings supplied at Q1, but the demand for loans at Q3. So you've got an excess demand for loans, not enough funds to supply that demand. So again, market forces get into action and move you back towards the equilibrium. Now, no economists think that equilibriums actually are the end result of anything in markets. They are just market forces that tend to move things towards equilibriums. But there are so many other factors involved that no one would consider this as an explanation of exactly how markets work. But theoretically, it's a good little introduction into understanding what a financial market would look like, and how in any market prices produce those market signals that get resources reallocating. That's how markets work, but not quite as simply as is suggested by that diagram. There are as well, and easily recognised, many market imperfections and indeed market failures. And once again, Lecture 3 on Economics 101 deals with this in much more detail, but a few pointers so that you're clear on what we're talking about, because when we look at financial markets, we are going to identify market imperfections, and I need to explain them to you at this stage here. You have all the products that people buy, consume, produce, use, can be ranged. They're all economic products, but they can be ranged to two extremes. There's an extreme called the public good. And in economics, the public good has two characteristics which are non-rival and non-excludable. Where non-rival means if I produce it for one person, I can't stop other people using it. And if I'm a consumer and I consume this product, I can't exclude other people from consuming this product that I've bought. So for that reason, markets fail completely. There would be no market for public goods. Now, public goods are things like law and order, defence, external defence. A classic example in the textbooks is always street lighting. They are things that we all want, but we're not prepared to buy because we cannot exclude other people from their use. And therefore you need another way of allocating resources to public goods, because the market is a complete failure. Now, at the other extreme, you've got private goods. Their characteristics are rival and excludable, not non-rival and non-excludable, because rival and excludable means, excludable means that if I produce it for you, no one else can have it. If you receive this product, you can exclude anyone else from having it. Now, that's a product that you're prepared to pay a price for, because it's rival and excludable, like the clothes that you wear, like the food you eat. You're happy to pay a price because you have sole rights to these products. Now, of course, these are just theoretical extremes, and most products come between these two extremes with degrees of imperfections. And these imperfections are usually referred to as external costs and external benefits. That is, a firm produces private costs, that's what its costs of producing the product, and the consumer has private benefits recognised in the price that they pay for the product. But there are also external costs and benefits. That is, that when firms produce certain things, they might, say, pollute the environment, which puts an external cost, a cost to society of producing this product, which isn't accounted for, isn't paid for. Equally, you might benefit society by consuming a particular product or producing a particular product. And again, these being external benefits are not accounted for. Now, two simple examples just to get this quite clear are what are called merit goods and demerit goods. Merit goods are products that will be underconsumed in a marketplace. The example is often health and education. If you had to pay the full price of health and education, you would consume a lot less than you would consume if there was a zero price or a lower price for these products. Society benefits. There are significant external benefits from having a healthy society and an educated society. So we have what's called a private product, which has external benefits, would be underconsumed at market prices should we do something to subsidise or reduce those prices. And then the corresponding demerit good is the very opposite of that. These are products that are overconsumed in society and impose costs upon society, external costs. The examples often are smoking, alcohol, gambling. There are often costs of consuming these products which spill over to society and are not paid for. The problems of, say, passive smoking in the case of smoking, or getting drunk and going out and beating up people, or whatever it may be. I hope you understand what I mean there. So there are lots of market imperfections and market failures. No one's saying markets are perfect. Indeed, if you look at financial products, you've got, they're private products, so we're not concerned here with the public good. We're concerned with private goods, but there are lots of imperfections in financial markets. There are complexity. They're very complex products, and there's asymmetry in financial products. Asymmetry means that both sides of the contract that is made with a financial product have different levels of information, knowledge, and understanding about the product. And this asymmetry means that the producer might be selling you a product as a consumer that you don't understand. Examples of that might be something like payment protection insurance, PPI. Now argued that there was information failure here, that people didn't understand what they were being sold, why they were being sold this, and therefore there were significant compensations that came out of a recognition of the asymmetry that there was with regard to payment protection insurance. Equally, there's adverse selection. It can go the other way. A consumer, say, looking for a loan, might not provide the loan provider with all the information required and work very hard at trying to get a loan, and having got that loan it may be much more risky than was originally realised, because all the information, all the credit scoring wasn't available to the person who was lending this particular product. So a lot of imperfections exist around that. There are plenty of products that have external benefits as well. Car insurance, for example, if you're in a situation where you have a law which says everyone must be at least insured for third-party fire and theft, that has external benefits to society, because you know that if you have an accident, you're likely to have had an accident with someone who's got insurance, and it'll be very easy to deal with the claims, which would be much more difficult if people didn't have insurance. If people could choose to have insurance, then those who don't might create particular difficulties as a result of accident. So there's external benefits. For financial products, there are external costs for financial products. You do, if you possibly can, want to avoid in marketplaces monopolistic buyers, where monopolistic buyers means sole buyer, that there's only one buyer for a product, because that can create a buying situation which can often force down the price of a product to a level at which it may not be profitable to provide the market with a supply that would result if there was a market price for the product. Equally, monopoly providers of products, as I'll explain a little bit later, find themselves in a beneficial situation whereby they can reduce supply and maintain excessive profits because of their privileged position. So ideally, we don't want monopolistic suppliers or monopolistic buyers if we want our markets to work a little more perfectly, a little better. And there's also moral hazards involved throughout all of these things. For example, if the financial services has a compensation scheme for people who deposit money in banks, 85,000 will be paid back if your bank fails and you've got deposits in that bank, then you're protected by the government scheme to roll back 85,000 to you. Now that creates a moral hazard, because banks could say to their customers, look, don't put more than 85,000 in because you're covered up to 85,000. If anything goes wrong with this bank, no worries, the financial services compensation scheme will pay you back. The bank then might see opportunities to go into more risky assets because it knows that there are greater rewards in risky assets, and if anything goes wrong, their customers are all protected by a compensation scheme. No compensation scheme, they would be less risky in the things that they do. So moral hazards are created in financial products, and there are many market imperfections. I shall conclude that markets still do this best, but you mustn't think ever that markets are perfect places in which to perform. Now, we did start in the title with, are financial markets efficient? So let me again say a few words about efficiency so that you're clear. It'll be a bit complicated to start with, but I'll bring it down to something nice and simple and easy to understand very quickly. And there are many theories of efficiency in production, in business. Again, if you go to my Econ 101, Lecture 3, all of these points are explained in much more detail. You don't need that, but I'll just give you a few sentences about these things so that you start. For firms to resource allocate efficiently, that is, be allocatively efficient, then the price of the product needs to equal the marginal cost of producing that product, which means the marginal cost is the cost of producing the last unit of that product that was consumed, and you don't want it to be more or less than the price. You want it to be roughly equal to the price, because suppose the marginal cost of producing something was twice the price. That is, it cost me, say, £100 to produce this and I sell it for 50. Now what you're saying there is that the customer is willing to pay £50 to use up £100 worth of the economy's resources. That's inefficient. We can move to a position which will create much more efficiency if we reduce the output of that product, raise the price and settle at a position where price equals marginal cost. It's called allocative efficiency. Productive efficiency, all firms tend to have cost curves, average costs or unit cost curves, which fall, reach a lowest point and then rise as you carry on producing when you get economies of scale, it tends to fall. Diseconomies of scale is where it's likely to start rising again. And productive efficiency is often described as the lowest point on the unit cost curve or the average cost curve as I expand output. So that's a second type of efficiency that is referred to. Dynamic efficiency is a sort of over time concept. It's concerned with doing things like research and development, improving your product, and it's things that shift your average cost of production down over time. So a firm is dynamic or more dynamically efficient if it is doing things to shift its cost curves down over time, reduce its cost curves. You may come across something called Pareto efficiency. Now, Pareto efficiency, named after the Spanish economist Alfredo Pareto, is a situation where in the marketplace all consumers are perfect, they're all rational, and they all go out and buy things they want, and at the end of the day, when they've purchased things, they would have maximised the satisfaction they're going to get given the limited amount of money that they had to spend. And also, all firms are efficient in terms of the things that I've just described to you. There's a nice simple sentence that goes with it, which is easier to remember, because if your economy is Pareto efficient, it means it's not possible to make one person better off without making another person worse off. If you're Pareto inefficient, you can always reorganise things and make everyone better off. But once you're at that level of efficiency, the only way anyone could become better off is if someone else becomes worse off. You're at the most efficient position. And then for people working in financial markets, they would have come across EMH, the efficient market hypothesis. I will explain this at the end in a little bit more detail because it applies particularly to financial markets, and it's actually one special case to do with asset pricing. It's not a general case that many of the other levels of efficiency that I've referred to are explaining. Now, I said I'd make things a little bit easier for you at this stage, and often a very overlooked sign of efficiency is just profitability. Profitability illustrates to you relative efficiency. It doesn't necessarily illustrate any of the strict things that I've said about efficiency up to now, but it's an illustration of relative efficiency, because if there are similar firms in the same industry and one of those firms is more profitable than the other, then it's a reasonable assumption that one has allocated resources more efficiently, is using more resources more efficiently, is providing a more attractive product to the customer. And you can say, therefore, if you make more profits than other people, you're probably more efficient than they are. And if you make less profits than other people, then you need to think carefully about what you're doing and try and improve. So it's something that is easy to see. Just look at profitability, and as all firms do, they see very profitable firms. They want to know how they did it, why they did it, and they learn from that particular thing. There are plenty of overlooked signs as well in the economy of inefficiency. And I'll just mention a couple of things which you will come across as you build up your knowledge in banking and finance. You need to understand the difference between capitalism and crony capitalism. Ideally, in capitalism, what you would have is markets, lots of competing firms, fairness in the way that all of these firms are treated by rules and regulations. You want rules and regulations in there which create a level playing field for competition between firms. So every firm has an equal opportunity to be successful, and the better firms, the ones that allocate their resources more efficiently, will be the ones who succeed. And then unfortunately there's crony capitalism, which often involves government getting involved directly in this particular process and doing things which favour some of the people competing in the market, often against other people. Nice simple analogy, if you like to think of a football game. What you want is rules, regulations and referees to make sure it's a fair game, a fair competition between teams. What you don't want is the referee actually owning one of the two teams, or whose son's playing in the other team, or whose daughter's playing in the other team. You don't want that, because that isn't likely to create a fair competition. So you want to always avoid crony capitalism if you can, and unfortunately there are many examples of crony capitalism often existing, where firms become very big and very important. We have in banking the systemically important financial institutions, SIFIs. Now they tend to get priority treatment, and one might question, should they? They do, because the cost of bailing them out is very high, as was seen after the last global financial crisis. There's also a domino effect. That is, if one of these large banks goes down, then other banks are under threat. You saw that again when Lehman Brothers went down in the global financial crisis, that there was threats to other banks of collapsing, which is what led to the support for other banks. Retail banking, it's a business, and it is actually a business with a difference. I mean, I'm an economist who likes capitalism, likes free markets, and likes firms who are successful to succeed and other firms that are not to go out of business. So I'm quite happy for any firms, car manufacturers, clothing manufacturers, food manufacturers, if they're not doing what the customer wants, go out of business. Retail banks, however, are a little bit different. Lots of people criticise and go, no, you shouldn't bail out banks. But there is a reason for this which is different from anything else. I'll try and explain exactly what it is. You've created a situation where probably about 95% of the money in circulation in the economy was created by the business of banking. When a bank collapses, a big bank, it's likely to bring about a monetary contraction if you're writing off customer deposits at that bank. Now that monetary contraction will lead to deflation. It's exactly what happened with the Great Depression for a decade or so after the Wall Street crash. So there is an argument for supporting retail banks. I can't think of an argument for supporting anyone else in the private sector of the economy other than retail banks. And I wouldn't support them in an easy way. If a retail bank is making losses and would go out of business under normal circumstances, then let the central bank get in there. Take them over, give them a little bit of tender, loving care, sack everyone at the top who made all the mistakes that led the business to default, replace them all, settle them down, and then return them to the market. You don't destroy the deposits that were made in those banks. You need to protect that. So there is something there, a job for a central bank to do efficiently, which is to support retail banks if they get into problems, but if the worst comes to the worst, get in there, find out what the real problem is, sack all those involved in it, and introduce a new board of directors, a new series of managers to create efficiency in that sector. The idea of efficiency, again, is interesting if you look at it from the point of view of theories of the firm. Again, this goes back to economics. If you want to read more about this, you go to lecture 3 in Economics 101. But again, just simple things so that you know the terminology, you understand what is going on. And there's a financial services industry, there's an insurance industry, there's a retail banking industry, if you like. What does industry mean? Industry is a collection of firms all producing the same or a similar product. Firm is a legal entity, so Barclays is a firm, HSBC is a firm, they're legal entities, and they're all part of an industry. And there are interesting theories about what happens in an industry which has got lots of firms as opposed to an industry which has only got a few firms, or indeed, at a theoretical extreme, an industry which has only got one firm in it. And you would come across the two extremes. There's an extreme of what's called perfect competition, where you assume that there are lots of, I'll go through the actual assumptions, but you've got lots of firms all identical competing with each other, and it will create these outcomes. At the other extreme, you've got an industry which theoretically could have just one firm in it, and that will create different outcomes. And then more realistically, and this is spread across the whole of the financial services sector, you have many small firms in a situation which is called monopolistic competition, where they're really competing with each other, but they're all trying to seem to be different from everything else, because the only way really to sell your product to lots of people is to say yours is better, different from everybody else. Really it's not, but you're trying to create that image of difference, and that's called monopolistic competition, and it's many firms in the industry. And then there is the oligopoly argument, where there are just a few large firms that make up the industry. And rough rule that I'm quite happy to accept is that when you tend towards more competition, you get more efficiency. When you move away towards less competition, then you have problems which can lead you to less efficiency. So let me just briefly mention these to you so that you're clear on what it is I'm talking about. So a nice little picture for you here. These are the assumptions of perfect competition. You go, what sort of market would exist if an industry was made up of this situation? There are lots of competing buyers. There are lots of producers, sellers of this product, lots and lots of them, so much so that firms have to be price takers. That is, no one can influence the market price. They all accept whatever the price is and allocate resources to production within that context. Everyone is assumed to have perfect knowledge about everything, about their production, about their consumers. Their consumers know exactly what products are being offered everywhere and make decisions accordingly, and all the consumers are rational. All the products, it says homogeneous, they're identical. So it doesn't matter whether you buy it from this firm, this firm, this firm, they're all identical. So which firm do you buy it from? You buy it from the firm that offers it to you at the cheapest price. Remember, all the products are identical. We're not talking about any difference in quality for these products. And there are no barriers to entering this industry. Any new firm can enter this industry, and indeed everyone can exit without any constraints. And over the long run, all these firms will just make enough profit to stay in business. It's called normal profit. It's the cost of keeping the firm in business. So you need a reward to the owners, the entrepreneurs, the people who own these businesses, and it's the minimum requirement that they need to stay in business, which is normal profit. And if you had perfect competition, we can build up a model which shows what levels of efficiency you would get and where you would get them. I won't go any further into that, but you can, if you want to, go to the econ module and read more about perfect competition, but I don't need to give you any more information than that. At the other extreme, we got the monopoly. Now, the monopoly is many buyers still, so there's lots of competing buyers, but there now is only one seller, one firm in the industry. Now this firm can be a price maker. Remember, for perfect competition, all firms were price takers, but this one's a price maker because the monopolist can reduce the supply in the market or increase it, and change the market price. And by reducing the supply and raising the price, the monopolist can make excessive profits that can be maintained over the long run. Because to be a one-firm industry, there must be barriers to entry. There must be something that stops other firms entering this industry and imposing competition on this industry. Many government products are supplied under these circumstances, and indeed in the private sector, firms may be issued patents which give them monopolistic rights to produce things for a certain number of years. And it's a reasonable assumption that one firm is likely making excessive profits to have higher costs and lower output than if that industry was made up of lots of smaller firms. Having said that, I can prove that that's not the case, but again, that's something for a little bit more of a complex analysis than the simple one I'm trying to illustrate to you. The difference here is that the monopolist can make excessive profits and sustain them over the long term. Now, these models that we build are again theoretical. No one would expect perfect competition to exist, or indeed, well, there are some examples of monopoly, but very unlikely. This is what's likely. It's likely that an industry will be made up in what's described here as monopolistic competition. That is, it'll have many buyers and sellers, so it could have as many sellers as perfect competition and as many buyers. But what happens in reality is that firms can monopolise one thing. They can monopolise their name. And they can try hard to create a brand image around their name and persuade people that their product, although it's very similar, if not identical to other people's products, it's just that little bit better, that little bit different. Go down the high street, any high street, and you'll see loads and loads of hairdressers, all with great names, all providing you with the idea that there's a best hairdresser here, and it's how well you create your image, how well you market your product. Really, you're just one of many competing firms, but you're trying to create the impression of being slightly different. And this is much more realistic than perfect competition. You know, this is what industries are like, and it's industries where there is not much scope to reduce unit costs of production, so they tend to be lots of small firms that make up the industry rather than lots of large firms, and they will tend to be making something near what you would say normal profits, enough to stay in business, but unlikely to be making any excessive profits. And indeed, there are many examples in financial services of these types of industries. I'll explain again in a moment, because just before we do that, we want to look at the other theory of the firm, which is oligopoly. And oligopoly, there are still many buyers out there competing with each other, but there are now only a few large firms in the industry. And banking would illustrate oligopoly, although things are changing. Banking would have illustrated an oligopolistic situation. And this is quite an interesting area because it applies to financial markets in some cases. And if you understand oligopoly, you understand one of the problems that exists with large firms, and that is it's very difficult for large firms to independently change the price of the product that they're offering. And that's because there's something in the industry which is called a kinked demand curve that applies to each of the firms in the industry. You remember demand curves are sloping downward from left to right. And for an oligopolist, there's a little bit of a kink at the market price. And if the oligopolist puts the price up, they lose lots of orders, and it's likely to be loss-making for them. If they put the price down, they don't gain many orders, and it's likely to be loss-making for them. In other words, they don't have an incentive to change their price. Now, why it's fairly easy to explain, because if I'm a large oligopolist, I have a big share of the market, and I put the price up, all the other competitors go, thank you very much, and take orders away from me. I lose lots of orders. They don't raise their price and I lose lots of orders. Now, if I lower my price, because I would gain lots of orders by doing that, all the other oligopolists have to react. They all have to lower their price. And if they all lower their price, we all just take a little bit of an increased share in the market. So whether we put prices up independently or down, it's not likely to be a profitable situation for us. It produces what's called sticky prices and gives great incentive in financial markets to cooperate, not compete with each other. So there have been in the past banking cartels which set out the interest rates that all banks would charge. Now against the law. So there's something else which creates prices which are very similar across the whole industry. It'll become clear as we move towards the end. But oligopoly is interesting because particularly retail banking and the banking sector is made up of very large firms, an industry with a few very large firms in who want to compete but also have great incentive to cooperate. And if they cooperated, they could make more profits. If they compete, they will erode those profits. Now, again, easy to understand and a good thing to have at the back of your mind when you're trying to understand this within the financial services sector is game theory. Game theory was developed by John Forbes Nash, a mathematician, who created something which has become very influential in explaining decision making in a lot of different areas and is very useful in understanding oligopoly pricing and why it's difficult for oligopolists to set different prices. And I can create a simple example if I show you how, say, 3 or 4 firms get together, cooperate, decide what they're going to produce, what price they're going to set. They can all be better off. But unfortunately, you open the door to cheating. That's where it becomes a fun thing. If you've seen the film A Beautiful Mind, I was going to say Beautiful Vision, but that was a Van Morrison album, wasn't it? A Beautiful Mind, then Russell Crowe, I think it is, who plays John Forbes Nash, explains game theory perfectly as it developed in his mind when he's out with the lads on a Friday night. I don't know the numbers, so I'm making a little bit of this up. Out with the lads on a Friday night down the pub, and there is him and his 3 friends. So there are 4 of them. And 5 very attractive women come in, and all of these young lads see themselves with an opportunity to have a nice successful meeting with one of these 5 women. However, one of these women is absolutely stunning and the other 4 are very, very nice. So what John Forbes Nash says to his friends is, we must not compete here. We've got to cooperate. If we all try and pick up this very attractive woman, none of us will be successful. All the other women will not be interested in us, and the easiest is only one of us will be successful, but perhaps even none of us, because this very attractive woman will be so overawed that she will move away from all of us. So what we've got to do here is cooperate, not compete. None of us will try and pick up this very attractive woman. We will all go to one of the other 4 women who will be so pleased that we're giving them 100% of our attention, that it's likely that we will all be successful by the end of the evening in making an arrangement to meet a young lady again in the future. Sounds great, doesn't it? So cooperate in this oligopolistic situation, only 4 people there, 4 blokes anyhow, cooperate and we will all benefit. Compete with each other and we will come out of this a lot worse off. The one extra point that we've missed here is that there is now an opportunity for John Forbes Nash to cheat. Because if he can persuade the other three to stick to the arrangement and all go for the prescribed woman, then there's no one to go to this unbelievably attractive woman. So he has an incentive, as everyone individually has an incentive to cheat on this particular situation. And cooperation, competition, cheating are all some of the things that you need to take into account when you're looking at pricing policy in oligopolies, and oligopolies do exist in financial services. So if you watch a bit of game theory, you might understand a little bit about how pricing works. Now, within the financial services sector, there are sort of examples of all of the things that I've said to you. Foreign exchange markets, they're not quite perfect, but they are a good example of almost perfect competition. You've got your many buyers and sellers. You've got lots of people selling foreign currency. You have got a homogeneous product. Every dollar or every unit of sterling or every euro is identical. It doesn't really matter who sells it to you. You're interested in who's going to sell it to you at the cheapest price, because there's no branding of dollars sold by Barclays as opposed to dollars sold by NatWest or any other seller of these products. So it's actually a very good example of how information goes around very quickly. There's good knowledge of what's going on, lots of buyers, lots of sellers, homogeneous product, almost a perfect example of perfect competition, but not quite. If you looked at something like financial advising, financial advisors, there are lots and lots of them around, and they all want to tell you how they are the best. It's a monopolistically competitive industry, the industry around financial advice. If you want to look at retail banking, it's oligopolistic. There are a few large firms, as described, conglomerates, even larger, which may be doing all of the above, also exist. The Bank of England, it's actually a monopoly. It has a monopoly over the supply of currency in the economy. So that's an example of monopoly. And so indeed, theoretically, markets are different from how I've described there, in as much as there may be markets which do have very large dominant firms in them and a lot of smaller niche firms. So we're not saying you have to fit in one of these categories or the other. Now, the internet, of course, is changing things in the financial services sectors, because retail banks, which were oligopolistic with large investment in bricks and mortar, where there were significant economies of scale, are now being pushed by online banks, which don't have all those costs of bricks and mortar and which can set themselves up and compete and look as though they might be moving retail banking towards being more monopolistically competitive than oligopolistic. Having said that, we could, in this particular industry, expect a future with lots of competing firms, or it could be that the few large conglomerates have swallowed up all the small online. I think Starling Bank are going, aren't they, very soon to be sold to one of the large banks. You know, interesting to look at how things are going and whether we'll have high streets with no banks in them at all, or whether Handelsbanken and Metro Bank and those banks that are sort of picking out a particular niche where people do like local banks and local bank managers and a bank manager, they can communicate. Are we moving into a situation where we will have high streets with banks or high streets with no banks? Will we have only online banks? Will there be lots of small banks or lots of large banks? Something for you to think about. All great fun, that, isn't it? And then we come to the efficient market hypothesis. I said I'd say a little bit more about that because it's often thrown around within financial services and the financial services sector as an illustration of something important. It is important and useful, but it is actually a special case. It's a special case because it's something that applies only really to asset pricing, nothing else. And what you see with asset pricing, and particularly with things like arbitrage being a situation where someone notices different prices for the same product in different parts of the market and therefore buys quickly in one market, sells in another market, making a quick profit. All of those things tend to make speedy adjustments to prices. And what efficient market hypothesis should create a situation that it doesn't create. And therefore, you have to say, well, perhaps there's a weak form of it, and there's a semi-strong form of it, and there's a strong form of it. So there is a weak case for efficient pricing, the EMH model, where everyone has all the historical evidence and can make decisions based upon that historical evidence, but doesn't have all the evidence. So the market is fairly weak in terms of creating equal prices across the whole sector. The semi-strong market is the one described where all the historical evidence there and all the current evidence is there, all those things that people want to keep secret because they found out aren't there. Everyone knows about everything. Then you would tend to get equality of pricing through efficient markets. But then there's the strong form. The strong form says all the historical evidence is there, all of the current information is there, and all of the information in the public domain and the private domain are all available to everyone. No one's got any secrets, if you like, and under those circumstances, all markets will create equal pricing. And arguably there would be no rewards for speculation because no one would have any information that everyone else didn't have. And in fact, you'd all put your money into tracker funds because no one could beat the market under these circumstances. Which means if people do beat the market, then efficient market hypothesis is not a full explanation of how markets work. There are other things as well that need to be taken into account. John Maynard Keynes referred to his animal spirits, where it's more down to psychology rather than facts that lead people, and that if there are alpha animals out there doing this, then all the beta and gamma animals follow them, don't they? Not knowing why, but just knowing that someone is doing it and they always get it right, so let's do what they do. I don't know why we're going to do it, but let's do it. There's Robert Shiller, whose overreaction. Schiller's overreaction is people's imperfect response to new information, where people have different responses to new information, which rather damages the idea of efficient market pricing under efficient market hypothesis. There was even Alan Greenspan's irrational exuberance explanation, where in markets again, it's the alphas, if you like, the people who see something and do something, and others who follow and are very exuberant, which brings prices up in what was described as an irrational way. These valuations are wrong, but they're there because everyone thinks that they're right and are therefore following, if you like, a sort of herd instinct under these circumstances. So there we have it. It's a sort of a dip into how terminology, particularly the structure of industry within financial services, and how things might be more efficient, less efficient, might change in the future. Understand all this terminology and you'll be again a step closer to understanding the industry, how it works, and if the career then moves into that area, you won't be misled by people who use words that you don't understand. I hope you've enjoyed that, and we will move in lecture 6 on to another aspect of introducing you to financial markets, money, banking and finance. Thank you very much.